We're talking about stuff that got millions of views, that were posting things that were basically, nobody even knows if they were true, but they were accusing these people of doing things very bad. So now everybody's like, oh, don't invest. When you're like, you thought 2.5 years ago was the time to invest, when it was the worst time to be investing if you're trying to time markets. And then you say no when it's actually the best time to be investing. Now, one of the big things that has changed in me, though, is this. I don't think everybody should invest. And that has been a big change. What's up, everybody, and welcome to the AJ Osborne podcast. And we have a very interesting subject that we're going to cover today. This subject is really being driven off of things that have been going on online, including Twitter. Now, I know Twitter is just a dumpster fire anyways, but it has driven a lot of interesting topics and themes because there has been more or less what you might call a war going on. And I thought it was very interesting and I wanted to address it. Now, the first thing that we're going to discuss here is why you should not be investing. Now, this sounds weird given someone that is a big believer in actively participating in the upside of the economy through ownership, asset ownership, but it has been something that I've struggled with. So I'm going to make a confession. I have struggled with this idea of should everyone be investing? Not only should everyone be investing, I think should most people be investing? Take out even most. 20% of the population. So let's just say 20% of the population that is middle class to upper middle class. I guess that would be obviously upper middle class. But if you took, that section that maybe not a percentage, but middle class to upper middle class, should they be investing? Now, my prior answer was yes, unequivocally yes. And this was driven really by a few factors. The distinguishing factor of the separation of social classes and everything in society is simply driven through ownership. That's it. Asset ownership. People that own stocks, own real estate, own companies, on and on and on. They will be disproportionately affected by the economy. They will be massively disproportionately affected when markets go up. So their wealth, their income, and their life will disproportionately increase as the economy grows. Now, this has caused a lot of social issues. Let's get this off the table, though. I am not talking about people that are in poverty, that are poor, that are struggling. This is not what we're talking about. We're not talking about the effects on that. That is a totally different social ring that is in a certain point. In the United States, 80% of people that are in poverty or poor come out of it. It has one of the largest social class transference in the world. It is the poor people going to middle class is huge. Now, that changes rapidly amongst the developed worlds when you go from middle class to wealthy in the United States. That it's not so good. And that's an interesting factor, right? That we have great social mobility from poor to middle class, but middle class to wealthy, it's not nearly as well. And I think this is for a few reasons. First of all, it's harder in the United States because we are more competitive, but it's also easier in the United States to make it big. So in the United States, the odds of you becoming really wealthy are untouchable to any other country in the world. So that leaves this sliver. So to get to be really wealthy in the United States, we outperform everybody. To get from poor to middle class, we're in the top, and that's social mobility. But there's this gap from the middle class, right, to wealthy, and they skip it. And I think the reason is our markets are competitive. So even if you start businesses, things like that, it's hard. And the next side is that lots of people, even with what's going on in the economy, inflation, things like that, the middle class is struggling more, and so investing in assets has been hard. But the thing is, this has happened forever. So this isn't necessarily a statistic on social mobility that has changed vastly over the last 30 years, let's say. So we also have to take that into consideration that, okay, even though during different periods of the time in the economy, of course, some periods it's easier, some periods it's harder. That is true everywhere all the time. We are in a period right now where it is harder due to the lack of capital, the high interest rates, high inflation. Middle class is having a harder time saving money to invest in assets, and they have less assets to choose from. Assets aren't performing as good. That means you have the overall velocity of money is slowing down. But that's not a bad thing because that always happens. Now, this moves into my thinking and my viewpoints in the world. Now, I've really focused and shifted on this podcast back to its original purpose, which you guys obviously will notice and everything. And that's for me to talk about what I'm talking about and what I'm seeing and what's going on. I think that it's more important time than ever for me to be talking about these things, having transparency and what's going on, just because we see a lot. And we see a lot more. I own multiple businesses. I just purchased a new business 2 weeks ago. I started a new software company. We have lots of assets. We have our private equity company that does storage. We have development. There's a lot of things that we see going on. We have lots of investors. We have lots of exposure to the markets. So when we look at this, I try to let people know what's going on. Now, one of the big things that I'm also trying to be very upfront and I'm trying to share more of is my thinking and my thought process for it. This is going to be more like almost a journal slash therapy. We'll put it that way, everybody, where I'm discussing how I am personally changing in my thoughts and philosophies. My biggest change that most people know about was when I became paralyzed. Now, after that, some big things changed in me. Some were for the better, some were for the worse, as most things. And I want to talk about how those things have changed, but really, there's a few key indicators on investing and individuals and becoming wealthy that have changed again since that time. When I got out, I was very, very passionate, and I wanted everybody to own assets in the economy. And prior to, obviously, my hospitalization, I had never taken an investor. We didn't do that. It was all our side businesses. It was me, my dad, and Sam Whitaker, that most of you know. Those are my two partners, and we were doing everything ourselves. After that, I wanted to teach. So I never taught anything before. I wanted to teach, but then I also wanted to allow participation. And I had a goal where I'm like, I want everybody to try to get in. It was this idea of saving capitalism and how we can do it. Now, one of the big things that has changed in me, though, is this. I don't think everybody should invest. And that has been a big change. Once again, I'm not talking about people that don't have savings. We're not talking about those people. I'm talking about people that are middle class. They have money. They maybe have a little disposable income, or they may be able to figure it out themselves. They actually have the ability to, okay? They have the mental, physical, emotional, right, kind of abilities too. But that, well, maybe not, they don't have it to make it or do it. They can perform the function of actually buying or investing. That's all I'm talking about. They can actually perform that function. They have $1,000 and they can invest in a stock or whatever that may be. The previous thought for me was lower barriers of entry. The only separator were asset owners versus not. That's business assets, everything else. The people that were asset owners and business owners, they so outperformed everybody else. And that's obviously because they owned things, that the best way to help society economically was to allow participation. So with that motto, I drove everything. And that motto has to be modified now. And the reason being, I will explain. So why I don't think you should be investing. And for people that say, okay, well, maybe I don't meet that criteria, great. But here's the reason why I don't think people should be investing. First of all, it is hard, okay? And two, it's not guaranteed. And also, when you look at investing and everything, you have to be able to mentally and emotionally take it. Because we are in a time, and this is maybe what I didn't understand or get right, the largest generation that has ever hit America in terms of numbers are millennials. the vast majority of millennials, we're talking 90%, right? They're in the workforce now. They're the largest generation in the workforce. They're the largest generation that has disposable income and now is investing. It's the marketing of everybody everywhere. They're trying to get those millennials as they're coming of age and getting jobs, everything else. And these people that are now in the workforce now are trying to invest. They're trying to make something with their life. They're trying to buy houses or whatever it may be. The vast majority of them have never been through a recession, ever. They've never invested through recessions. They've never participated in one. They've never really seen the effects of it. I guess a lot of them saw 2008, but they were at college or they were in high school. They were shielded from it. They didn't understand it. They didn't understand the effects of it. They didn't experience it. They weren't invested in working in it. And then after that point, when they started going in the workforce and everything, they saw the biggest bull market the world has ever seen. And then at the end of it, they accused and wanted to rip on baby boomers because baby boomers made a lot of money and their houses appreciated. And this is the same class that was just slaughtered in 2008. Then millennials said, well, wouldn't it be nice? Well, if I could have done that or whatnot. To the people that survived and didn't survive the greatest financial crisis since the Great Depression. That alone to me is intriguing. This woe is me type thing, because we are now in high inflation and a hard market. I get it. It is hard right now. If you are in businesses that are defined by capital and assets and controlled by interest rates, it sucks, right? But here's the thing, though. It's not that that's not supposed to happen, meaning that this is a normal functioning part of the cycle. It's something that not only can happen, it's guaranteed to happen. So I think we're in a point where I've realized that a vast majority are okay if things don't have any hiccups. Now, I'm not talking about losing money. That obviously is different. I'm just talking about the struggle, the performance, everything else. I'm not saying it's not hard. I'm not saying it doesn't suck for you. I'm not saying any of those things. Of course it does. But I am saying that that's life. That's how it works. And a lot of people, I don't think, can understand that, deal with it. And all these people that said that they would have invested in 2008, and if they had the opportunity, totally opposite now. No, they're not. They're not only not, they've complained about not being able to do it, and now they're running away. Those capital markets have just been obliterated. Like these, nobody's investing, things are shutting down, and it's starting to accelerate. We're starting to get job losses. Yeah, of course, we have high interest rates. Now, you guys know on this podcast, I've been talking about this stuff since 3 years ago. And there's a reason why. Because, first of all, it's known. You need to be able to operate it. But also, there's huge opportunity. Now, opportunity does not come, though, after the danger has passed. That's not how opportunity works. It only comes when the future is unknown. If the future is known, markets stabilize and price for future prices. So, prices and markets, they project the future and they price it. So the markets trail prices. They're trying to get to the expectations of investors. This is a natural phenomenon and occurrence. It also happens in reverse. Okay? What it means, though, is if it's safe, the prices have already, they'll build that in and they will project it. People will be buying it up because they're buying future gains. When you get opportunity is when you don't know, where there's actually danger and it's not safe. This is what people don't understand. They think, oh, I would take it, I would do the things that everybody else wouldn't. I would be different. I would be able to control my emotions. I would be able to think and control fear, things like that. When it happens, though, they're not. And this is something that I've seen individuals, investors go through as they're struggling, as they have an asset, as they just bought, and they're going through this and they're like, I should have never done this, right? Or even not, I should have never done this, but they're like, I don't like this, I'm scared, I'm different things like that, which is understandable. I don't think that that's bad. You should be. If you're not, you're like a sociopath. That doesn't work. It's different though what you do with it. So as we've looked out, the drama and what's going on, we'll hit on the Twitter sphere now. There has been a war, which really surprised me about 2 weeks ago, where all these accounts were taking general partners and investment groups, things like that, and they were calling them out. They were posting private information out online, and they were attacking people that managed money. And I was not in this. I was watching this, even though I'm sure somebody would. They're going after everybody, literally. And these were great operators. We had one particularly that most people know of that's out of Texas that has a incredible track record, reputation, very honorable, and has a great company. And his company is not failing at all, but they did pause distributions to their investors, which they should do. And they should have done it earlier, I believe, but that's neither here nor there. The fact was, though, then what happened on Twitter was they started to say they're a fraud, they're failing, and started bashing on this person. And this person with 150,000 followers that gave incredible insight to markets and telling people how to invest, what to do, how to do things right, left completely, stopped putting out any of this free information. There was no charge, there was no nothing, there was no even anything. He was just simply sharing his company, how he built it, what they were doing. Now, this happened to multiple accounts where these investors, they left. They're like, we're done. We're not sharing anything anymore with other people. And we're talking about stuff that got millions of views that were posting things that were basically, nobody even knows if they were true, but they were accusing these people of doing things very bad, not even because they lost money or failed, which even if they did, the investor is investing. But that didn't even happen. They simply paused distributions, which right now most operators are. That's standard across the board right now. I firmly believe that operators should have paused distributions sooner. The amount of capital calls that are going out, and everybody, a capital call is where you have to tell your investors, we don't have money, we need money, and that investor has to put more money in. I have friends that have multiple funds that they are either doing capital calls or they're invested in and they're getting capital. This is actually normal right now. We're seeing this all over the place. The people that I just mentioned, I was talking about on Twitter, they weren't doing that. They weren't doing capital calls. They didn't need money. They just paused distributions. But if the individuals, they should have paused distributions. They should have stopped giving excess profit and things to investors, I believe, a long time ago. They should have stopped that probably before 2023. Why? Because the markets were clearly struggling. That wasn't turning around. That wasn't going to go anywhere. And the occupancy was going down and rents were going down. So they knew that things were going down. But what I believe happened, and what I've seen happen, both from the partnerships and the investors on the side, is the partnerships did not want to not only deliver bad news, they did not want to pause distributions for two reasons. First and foremost, they did not want to look like it wasn't meeting their projections or they weren't doing as good. They were very concerned about what the investors would say, how they would react. And the second thing was it actually affects key metrics like IRR, which shows performance, which allows them to get more money from other investors. Because they needed more money from other investors, they did not want to stop anything, so they actually just would drain accounts and things like that. That made them get into a position that was very bad that I believe could have been avoided, right? So the key here is, though, on both sides of this, I'm talking about my side, because I am both a general partner and a limited partner, not only in my own deals, but other deals. I invest with other people. So we manage people's money, right? We invest with other people. This is what we do. We allocate capital. We run investment firms, everything else. When I look at the other people that have done this, one of the large things that these people hadn't been through a recession. Their investors haven't been. And so once the distributions paused, not all, but a segment of the investors not only were scared, they started to threaten. They were very upset, which first and foremost, that's understandable. You want a return, obviously. I mean, why wouldn't you be? And the general partners, they didn't want to upset investors. So first thing here, to those of you that are general partners or managing money, I'm going to be very clear here. I have kind of gotten I don't want to say a reputation or what nickname, but one of the things that I tell all my investors is you're not my first priority. And that is something that shocks them because I don't think any general partner would ever say that to an investor because they're trying to appease them. But they're not. The asset is. The asset is. Because if the asset fails, everyone gets wiped out. That should just be obvious. As an investor, I would hope that they would do everything to ensure the profitability, protection, and future gains of my capital and return over investors' wants and needs in the short term. That is why, everyone, you are a general partner. You are an investment manager if you're doing that, if you've taken investors, because you're going to make hard decisions. And you are going to do things that correctly manage, operate, and allocate capital. The only person that I have ever seen that did not have a down year, paused distributions, didn't have any problems, and wasn't generally affected by market turbulence was Bernie Madoff. Everybody else, Warren Buffett. Do you know how many times people have called the end to Warren Buffett? The oracle's over. Why? Because in the downturn, he's outperforming and he's not doing as good and things aren't, it wasn't what they thought they'd get and he didn't meet metrics, everything else. In the short term, so everybody said, oh, you're dead. But obviously that's not true. He is affected by markets. He doesn't worry about those short-term things. He protects investors' capitals, makes fundamental good investments, not ones that are just hot. He's focused on value, right? Value creation over the long term. At risk and at basically vulnerability of the short term. He buys when things are bad and he doesn't even know if they're going to get good. But over in the long run, it will. Because the short-term things he knows will be overcome. This is foundational investing principles and theories that I believe everyone should abide to. Investing is not getting rich quick. Investing is truly successful through compounding of capital over the long term, but you cannot control markets. Short-term markets are unknown completely. You don't know what they'll do. Now, for everyone that says, oh, that's bad or that's scary or I shouldn't be investing, here comes the problem. You want to pick when markets are doing good to invest and avoid when they're doing bad. That means you are timing markets. That is impossible. And that almost always means you will just end up losing money. That's why everybody started investing and all capital started moving and buying after 2018, right before interest rates skyrocketed, right? That's when all the capital moved in. It was 1920, everybody was making money, everybody wanted to get in. That was the peak. Right? So now everybody's like, oh, don't invest. When you're like, you thought 2.5 years ago was the time to invest. When it was the worst time to be investing if you're trying to time markets. And then you say no when it's actually the best time to be investing. This is classic markets, right? This is also what people call dumb money. Not a term I made up. It's Wall Street. So dumb money means they follow the crowd and they always invest in the wrong time. The peak and the failure. So now you may say, okay, AJ, well, what can I do? I can't time markets. So how do you time markets? I can't either. Nobody can. We don't buy based upon timing in markets. We buy based upon value creation, fundamentals, understanding that things are going to go wrong, understanding that markets will go down and they will go up. Over the long run, though, markets will revert to value. Short-term markets are inefficient. Long-term, they price effectively. I can't control, though, the timing that markets decide on that. So instead, we invest for the long term, value creation. We make sure we can ride out, survive any things that fluctuate short term, and then we win. This is why we did not fail in 2008. This is why instead we took advantage of it. When we were buying, though, in 08, 09, and 010, we were basically ridiculed by any expert or anyone we knew. We were buying in the middle of a real estate crisis and prices were going down. And guess what? A lot of our assets, when we bought them, their value did go down. They went down after we bought them. But it didn't matter because we were making our return and cash flow and it was good and it made sense. So we bought them. You go back 5 years from there and it looks like we bought pennies on the dollar. It's like, holy cow, you guys bought incredible. Like, it's amazing. You timed that perfect. We didn't time it. In fact, if you saw in the short-term timing, we would have been wrong. But that's the point. We don't know, we can't, so we don't try to. We know when value is good. We create value. We let markets do what they will. By the time you believe that values in markets are going to go up, you're too late. You missed the bottom, because the bottom's done in unknown. Why? Because that's when capital leaves, because it's unknown, and that's when values drop the most, because it's unknown. So you have less demand and you have more supply for assets. So you have less demand for assets and more assets are trying to sell. That's what makes it. If you have demand for assets, people that want to buy because things are going to go good, you don't have that delta. You don't have that price. So when we look at this, most people, the short-term fluctuations are too much for them. Now, first of all, if you needed that money and it had to go perfect or you were going to risk everything, you shouldn't have ever been doing it in the first place. That was a bad idea. You shouldn't be investing money that you have to have in the short term. Absolutely not. That's a horrible idea because you don't know and you can't control those things. So first of all, get rid of that group of people. That's wrong. The next thing is, if you cannot and you're not comfortable with market fluctuations, right, and investing and understanding that those things will happen, you should also not be investing, which that's hard, because then what do you invest in? You should just go to at that point, emotionally and things, it's better, invest in an index fund. It's still not going to go. You're still going to have down markets, but maybe the down market, because it's just diversified and plateaued, will be way less. Now your upside's going to be way less, and you'll just over the long term make a return that, hopefully beats inflation. And that's fine. That's okay. There's nothing wrong with that at all. But that doesn't mean you should be an active investor. Okay? And that doesn't mean you should be investing in real assets that you own and produce. That's a totally different game. So when I saw on Twitter, first of all, everyone bashing on these people, and also investors bashing on them. Why? Not because they failed, not because of anything like that, but because they weren't getting as high of a return as they thought that they were going to get over that 2-year period or whatever it was. That was puzzling to me. First of all, they made the decision to participate. But second of all, they didn't even lose their money. It just wasn't as high. It would be interesting to see people to go on Twitter and start bashing on their index fund that they are in because the market was down 20% and their index fund was down 8%. And then all of a sudden you get just tons of people just ripping on this index fund that they're invested in, saying they're frauds and they're bad. No, of course that would never happen because that would be ridiculous. The market's down. And this is what I mean. Some people should not be investing in direct investing. This whole idea and concept that challenged a lot of fundamental beliefs that I had, that I wanted to believe, that I thought of. And it changed my overall thinking. Now, it didn't throw away everything, but it did limit my scope. So whereas before I thought, no, we really want to try to get everybody in the investing game, I don't think that anymore. I don't believe it. In fact, I'm largely against it. I think that you should open up and add access to certain levels of people, but those people need to be people that more have the capacity, not financially, but more mentally in the stigma, and they understand what they're doing and the long-term nature. We assume that people do that when they direct invest. That was the assumption, right? You're an accredited investor and people are, they can do that, they can find it. And I don't believe that anymore. Now, that makes me feel bad, first of all, because I know everybody says that, and I know people, but I just didn't want to think that too, because I just wanted to think that everybody should be doing it and can do it. Now, I think there is a large segment of the population that can. And we want those people to be engaged, investing, be asset owners and participators. And we want them to improve and make better decisions, smarter decisions. And we want them to be actively engaged in the economy. Of course we do. That's something we want. And that's what we're going to strive for. But my thinking has changed. And that change I've been dealing with for the last 6 months. How my companies are set up and what we do and our purpose. Because prior to that, I stayed away from major family offices, institutional money, everything else like that, because we only wanted to give offerings to people that normally didn't have them. That was the only goal. So I know for me in my company and a lot of other people that I've been talking to, general partners, everything else, they're actually going away from that and they're going to limit the opportunity. I've resisted that to say the least. But now moving forward, we're going to be. And we have decided to do a new structure on how we're offering investments, everything else to people. First of all, we will be partnering with much larger capital sources, institutional family offices, because it's interesting, anybody that deals with money, if somebody gives you, $400,000, they lots of times they really need that. And so you need to be way more careful about taking those people's money. And you need to make sure that they can handle it and everything else. People that invest large checks, $1 million plus, they understand the game and we get it. We understand markets are down, whatnot, and they're fine with it. They understand the overall business plan. They understand what they're doing, and they're in for the ride. I want people to understand the things that those people understand. I want them to have the comfort level and be able to analyze those things so that they can perform and do those things. It does not mean that they don't have fear or they're not scared, and it doesn't mean that they're okay with losing. No, that's not what I'm talking about at all. When we made our first large investment on a real estate asset, $3 million, in the middle of the recession when things were going down, I was scared spitless. We had a $2.3 million loan on it. And I thought, I don't know how this is going to end up. Hindsight, it looks so easy. Like, yeah, of course. But at the time, I was scared, very scared. The difference is, though, I was okay with the emotion. I understood it, and I actually let the emotion help me. And it didn't prevent me from moving forward. I also did not make radical decisions in the short term because a plan didn't go the way we wanted it to in the short term. Instead, we would keep a cool head. We would look and say, do we need to make changes? Is this something we can affect, not affect? Do we need to ride this out, or does a dramatic decision need to be made? Very, very rarely has there been ever an instance where we needed to make a dramatic shift, do something like sell off the asset or, whatever that may be. That's rare. That rarely happens. Now, I see lots of people make those decisions because of emotions in the short term. And then in the long term, they realize they would have been way, way better off. This is how you need to be. You need to be like Warren Buffett, where you can control your emotions, understand it, and even if people don't see what you see, that and you can stand and say, it's okay, I'm going to do it, right? This is really hard. This is not easy. The first time I went through it, I did not like telling people I was buying up real estate in '08 and having people look at me like I was a leper, or then being told, you do understand that real estate values are going to go down. And I'm like, yeah, I guess I do. So I guess I'm just an idiot, but it makes sense. So I'm like, the returns that I get, they qualify and they meet my objectives. In fact, they surpass it. And that's non-market effects. And over the long term, this should work out really good. And it was kind of like, okay, dude, whatever you want to do, right? You're going to get that all the time. All the time. That's normal. Because those short-term intervals, people perceive different things and their perception becomes reality. And that reality then drives very strong emotions and fear. And then they react to it, even though they don't know that that reality is just based upon something they perceived. They haven't separated things out and looked and said, no, here's my numbers. Here's what we need to do. We're not changing. We're moving forward. Like, these times will pass. And sometimes, though, you did a bad thing. You made a bad decision. That's different. Then you look at the numbers and say, no, I screwed up. We screwed up on this. We need to do something dramatic to fix it, or we need to. That's fine, too. Okay? Then you look at it, you make the decision, the future, how it'll be affected, will be going on. But it's pragmatic, not being driven by fear and not being driven by short-term things that are going on. Most of the time, you can't see that right away. You have to wait. You have to let markets play out and see things. People don't want to wait. They don't want it. They need a fix to their emotional distress immediately. And they will do it at a downside to themselves. We're seeing a lot of that today. And on Twitter and other spaces, it was obvious the amount of emotion because people were cheering when other people failed. That is wild to me. Or even perceived fail. They didn't actually fail. But everybody was so excited to jump on that and say, yes, I knew it. See, that person is really not as good. That person really isn't successful. Why? So they can feel better about themselves? Or because they are mad of the emotional distress that they're in because the markets didn't work out that they wanted to in the short term. It's going to probably be just fine. The people I'm talking about, I'm not worried they're going to fail. Okay. It's going to be better in the long term and they're going to be fine. Now, the short term may be rough. Yeah. The way that people piled on is very different because we didn't really have this. We didn't really have social media. We didn't have adaption in 2008 of social platforms, and there wasn't a culture of entrepreneurship and investing. It wasn't like that is today, and it wasn't transferred online like it is today. So today, in market turmoil, I think is the first time a lot of people are seeing the reaction of others to them. It's definitely one of my first times seeing these kind of things and reactions, where we have general partners and investors that are making bad decisions, predicated on things like social media. And that to me was a surprise. I was surprised at the level and what was going on amongst investors and markets online and how they reacted. I guess I'm a little naive maybe, or I thought too much that people had either not better understanding, but they could control themselves and things like that. That didn't play out, which is fine, which made me think about who should be investing and who should not. Like really, who should participate? This is the first time that we've had a down market, people, in a decade? It's the longest bull run we've ever had. And the first time it starts to happen, people start to freak out. These are people that won't obviously be able to take opportunity because they are either freaking out or cheering that people are failing and glad. So they just think the world is going to fail. Positivity makes money. Negativity is right every so often, every 10 years, right? There's a recession. Then they're proven right because of something that they said. I guess that's good and that gives you a dopamine hit, but you did just miss out on the massive bull market. So while you were cheering today that somebody else is either failing or not even failing once again, just not doing as good as they said, so they're not as good as you thought that they were making out to be, and you're cheering for that, well, you lost every year. You were always losing. So they're losing one inning. You lost the game. Why? The amount of people on our platforms and everything that we know that have bought assets that even though they're struggling, they're doing good, they're asset owners, they have wealth, they've changed their life and are changing their life is incredible to me. And I think those people are going to make an absolute killing in this next go around. We believe that, and I've been saying since start of 22, we've had tons of information. You guys all heard it. It's been annoying. But that we've said 25. So 24 is the adjustment period. 25 is going to get better. And 26, 27, 28 is awesome. That means, though, that you have to be buying in 24 and 25. And you have to be running those assets. You have to be on it. It doesn't mean they're failing, anything else like that. It's just markets aren't going to naturally lift things up. We thought that's a normal part. We didn't think that that's obviously not weird or strange. But the values and your returns are not equal, meaning that you have a down year, maybe you didn't get a return, or maybe you lack performance, right? Okay, but then in an up year, you recapitalize, you sell, you do something. The returns are so disproportionate in those times. That's why you go for the long term, right? And you make it so you have the availability to capture returns in the upside, but not take the losses in the downside. I mean, not get in trouble, not lose your money. Then it averages out. So when you look at people's returns, they're averaging out returns over years. No, people didn't make a 10 to 15% return like clockwork every single year, unless you're talking to somebody that is looking backwards over the last 10 years and they started once again in 2009, right? We didn't. We went through the recession. That's not how it worked with our assets. That's not how it'll work through this one. It's not how it'll work through anyone. We don't. That's part of it, right? We understand this. So the message to everybody listening to this is if you're taking people's money or if you're investing, you need to be contrarian. You need to look at fundamentals, wealth building principles, and you need to decide whether you should be in this game or not. And if not, that's fine. That's okay, right? If so, you need to take a step back and start investing with long-term vision. That will help you understand how to limit risk from short-term cycles. That will help you protect you from the downside of those cycles. And when you do that, you can create equity, income, and wealth over the long term. Everything we look at is at minimum equity conversion events from, we put, basically 5 years. So we look at it from 4 to 6 years, periods. That's where we're going, okay, this is when we'd like an equity conversion event. We don't plan a sell though during those times because we don't know if that'd be possible or available. So those are always like 10 plus years out. It doesn't mean it doesn't happen. We've built it and done it. We financed or we sold things or we took tons of money out or we had a great market in 2 years, in 3 years. We've had opportunities in literally 6 months after we bought assets for. But that is not a norm and we would never expect that because the opposite can also happen in the short term. So you plan for the long term, protect yourself from short-term cycles, and then you take advantage when it is the upside. That's how you win in investing in entrepreneurship. If you don't, you're at great risk to just falling behind or away like the other people that were planning on short terms and the market just turned on them. So you shouldn't be investing unless you can take a step back and see that. Now, if you can, and you're okay with that, and you can analyze risk and protect yourself from the downsides and do the fundamental things, right? Then you're going to make a lot of money. A lot of money. Now, it's not a get-rich-quick scheme, everybody. We've been doing this for 20 years. This is a long-term game. If you're looking for something get-rich-quick, sorry, I just don't believe in it. It's not that I don't believe that it happens. It does happen. I don't believe that it can be planned. That's the difference. We've made millions in a very short period of time. We're talking under 2 years. That just happened to be lucky that markets played out in that short term in that rate, which is awesome. We love it. Thank you, markets. But we don't believe that you can plan that. You just can't buy a stock and know that it's going to go in 2 years, it's going to double or triple. You can't do that. So any get rich, right, is only an action of a expressed value being taken or you receiving that in a shorter period of time frame than was expected, right? And that is largely due to luck because it incorporates so many things that you cannot plan and you have no control over. Those things just have to work in your direction in a certain time frame. That is so dangerous if you're playing that game and if you expect that game. Don't do it. If you're going for the long term, it plays out in the short term. Take it, love it. But it's about making income and creating wealth. It's not about doing it in 6 months. It's not about not having downside. It's not about not ever having a down market. That's not it. That's not what we're talking about. I would rather have a proven strategy that plays out over the long term than something that is not proven, incredibly risky, but may happen in the short term. Right? So get out there. And if you are an investor, start working harder. Get out there and find these opportunities because the opportunities that we're starting to see, we're getting seller finance deals, off-market deals. We've purchased, we've got another one that we have under contract right now. In our one of our funds we rolled out, we had 2. And we're seeing these stuff. We didn't see these stuff prior. So these are incredible opportunities. These are game-changing opportunities, especially if you don't have money. This is game-changing opportunities. Now you have to work a little harder, yes, but these are the ones that can literally change your whole entire outlook. We have one of our students, he just retired. Like it's amazing stuff, right? But it wasn't get rich quick, and that's not how it works. So if you're investing, if you're ready to go out there and make it, broaden that time frame, understand downward cycles, understand that you may buy something that its market value may go down. And don't think that that even necessarily means you're failing. Work on the intrinsic value, work on cash flow. Don't worry about trading it or equity conversion. And then over the long term, yeah, you'll balance out. It doesn't matter. You'll be okay, right? And this is a very, very important thing. But if you can do it, I mean, overall, you will have failures. You'll make mistakes, everything else. But overall, you will be successful over the long run. And that's what we're shooting for, everybody. All right. Thanks, everybody. Get out there and get it.